Hello and welcome to your first week of online instruction for Wartburg. I know this is a really big change for everybody. Hopefully we can all get through this and return for fall semester with the world gone back to normal. So in chapter 24, we're going to discuss variances. So budget variances. One of the first things we need to talk about is a standard cost system. So standard cost system is a cost system that is set up where we say that we have standards for materials, direct labor, and overhead. So an example of this would be that if we do production perfectly, our direct labor always costs $14 an hour. So then direct labor is our standard cost of $14 an hour. And anything outside of standard cost is a variance from that. So when we compare actual costs with standard costs and with budgeted costs to see where we strayed from what our planned results were. So variance is a difference between our actual and standard input prices or quantities. It's favorable if it saves us money. So if it causes net income to go up, it's considered a favorable variance. If it causes net income to go down, it's considered an unfavorable variance. Well, what kinds of things cause variances? Any number of things can cause variances. But we see from this screen here that we have our actual quantities and costs assigned in the blue. Then we have a variance and we have our standard quantities. The variance is the difference between the standard and the actual amount. How do we determine what those variances are? We'll do that in a couple of slides. So first we establish our standard costs. We can revise them as needed. For example, if there's a big rise in inflation, or if costs go up because of some major event such as a global pandemic, or if we're running out of items and we have to choose a substitute product that has a different cost. So we might have to revise what our standard costs are when we make revisions in the production process dealing with various issues. However, under ideal conditions, we would not have any inefficiencies or any variances. We would never have waste or spoilage or breakdowns, etc. So we call this management by exception. So this means that our management level of expectation has to be less than ideal because we know that we can't operate in a perfect world. We know that we have to account for some downtime for various reasons. So direct material standards, we have the cost of material and the quantity of material. So in this example here, we're talking about the amount of mozzarella cheese used in the production of frozen pizzas. So we have that it costs $2.40 per pound. And if we measure out the amount of cheese we put on each pizza when we're making it, we allow 1/4 of a pound per cheese. Therefore, our standard cost of cheese per pizza is the $2.40 per pound times 1/4 pound, or 60 cents per pizza. So we have to understand those relationships between cost, quality, and selling prices. So we already know that high quality materials generally cost more than lower quality materials. However, especially depending on our manufacturing process, higher quality materials mean that we usually have less spoilage or less product defects, which can result in less waste. Other things that we have to consider is our storage, availability of access to products, shipping costs to get those products to us, how we might dispose of waste if there is waste. In some instances, we'll be able to rework the product and sell it at a different price or scrap it like we saw in an earlier chapter. sometimes, especially in food, we just have to throw that in the garbage when something goes wrong in the production process. For labor standards, these are set much like the material standards. We have a wage rate that we pay our employees, and then we have an amount of time that it takes to produce each individual product. So we're talking about a production worker in a manufacturing facility here. They get paid $15 per hour, and they predict that it takes 3 hours to make this particular table. Therefore, the standard direct labor cost per table is $45. That's their $15 direct labor rate times the 3 hours required to make the table. We can also have differences in our direct labor standards. So we have to know how much our employees cost, how much time they take. Some employees with higher skill sets are more efficient than employees that are just learning. So sometimes we need to take that into account also. That would help us with our production manager would know which employees have been there longer and we have less time than the 3 hours versus the 3 hours that a newer employee might take, or a newer employee might even take 3.5 to 4 hours because they're still learning. For manufacturing overhead, we base on an estimate of our overhead at a normal level of production. So this is much like we've talked about establishing our overhead rates in other chapters. So we determine what our budgeted overhead is, and then we use that information to choose a predetermined overhead rate or multiple if we're using activity-based costing. And we use that standard throughout the entire year. So we apply our overhead to production at that standard cost that we estimated at the beginning of the year. We have fixed and variable overhead costs. So we'll separate it into fixed and overhead costs. We already know a lot about cost behavior from previous chapters. So we know that fixed manufacturing costs are not affected by changes, short-term changes in the level of production. So within the relevant range, or a relevant range of production, that is where fixed costs stay steady. Our variable manufacturing costs can rise and fall, but that happens in change in production volume. This is usually things like our utilities, the amount of setup and repairs our machine needs, any indirect materials that we're using on our production or our machinery. So in this example here, we have budgeted total overhead for $5,600, and we predict that we're going to make 700 beams per month. So our overhead rate for fixed overhead is $8 per beam. So we also decide that we're going to apply variable manufacturing overhead using direct labor hours as an activity base. So that gives us a $6 per beam variable overhead rate. So our overhead cost is applied at $14 per unit or per beam. So in this example here, we show that we have standard costs for each of these 20-foot beams. Each beam is 264 board feet at 25 cents per board feet. So our direct material standard cost is $66. Our direct labor is 1.5 hours at a rate of $12 per hour, giving us a standard cost of $18. And then we already talked about the fixed and variable overhead calculations. So our standard cost per unit is $98. And anything that happens over the time of production that doesn't turn out to be $98 is a variance from our standard. So during March, we experienced production delays. We only produced 600 beams. So 100 fewer than our normal or budgeted output. So we have our total manufacturing costs for those 600 beams. As you can see, we already have some variances because it tells us that those 600 beams were 20 cents per board foot. Our standard cost was 25 cents per board foot, so we made those beams at a lower cost. However, our standard direct labor rate was $12, and we show here that we paid $13 in direct labor. How did we apply fixed and variable overhead? Are there variance there? So we look at our actual total costs and the standard cost we should have spent for producing 600 units. We see that we have a favorable cost variance of $80. So is that a good thing or a bad thing? We say, well, yeah, we saved $80. That's great. We can break that variance down further to see where exactly that happened. So as we look at the relationships among that, our lumber price is associated with quality. So if we saved money on lumber, we might have had issues like, why did we have so many delays that we had to produce less boards? So as we talk about this case from our textbook, it says that the purchasing manager spent so much, he saved so much money on these boards. We'll see that the direct labor or the direct materials variance was actually quite large. So he saved so much money on these boards that the quality was very low. And because of that, we required a lot of overtime. That's where we get that our standard cost was more than $1 an hour over. Our actual costs were $1 more than our standard cost because we had to remove knots, warps, cracks, etc. in these lower quality boards that we saved money on for our direct materials. We also might have had defects that were caught and a lot of scrap and a lot of waste because of the amount of money that we saved on these boards.